Take a look at the market headlines here to start the hour. This is sponsored by Tasty Trade. You are looking at a bit of a reversal from the earlier declines for the S&P and the NASDAQ, both now in positive territory. You have the NASDAQ leading that rebound here, up just about 0.2%. The Dow just below the flat line. Now, this mixed action that we have seen for much of the morning following the jobs print that we got out at 8:30 a.m. Eastern time. When you take a look at the headline number, it was a slight miss there. Unemployment ticking slightly higher, but again, the initial reaction was that it wasn't as bad as feared, and that was enough to alleviate some of the trepidation and concern within the market here. But here we are, not too far from the flat line, just about half an hour into the trading day. Flipping it over to the bond market, the reaction there, the move lower that we're seeing in yields. You got the 10-year yield at 4.26, so just off the lows here of the session. And then Bitcoin, we're seeing a little bit of risk on action here right now, at least in terms of Bitcoin. It is back above the flat line, up just about 0.9% above 90,000. And of course, that move coming ahead of the White House's crypto summit that could potentially be a huge driver here for the industry. That's getting underway in just a couple of hours.
All right, that February jobs report came in a bit weaker than expected, with unemployment ticking up to 4.1%. Now, this comes as big banks warn that markets are signaling growing recession risks, sparked by weaker data and uncertainty around President Trump's tariff policies. Joining us now, we've got Joe Lavorgna, the former chief economist at the National Economic Council under President Trump. Great to have you here, Joe.
Thank you.
I've heard, and Sean and I have both heard from a lot of guests this morning, that there's some evidence of slowing, but broadly the economy is holding up. So let's just not muck it up with any big policy shifts that could lead to an economic slowdown. How are you thinking about the potential risks of Trump's policies on our economy?
The too much growth, thank you for having me. Too much growth has been driven by government spending. We saw that last year with the budget deficit at nearly 7% of GDP against the backdrop of full employment. So we cannot stay on this path. That is a partisan issue. The question is how we fix it. The administration is trying to fix things, and I like their approach. But most important, we need the clarity on the tax package. There seems to be a disproportionate amount of attention focused on the tariffs, and it really needs to be more of the tax policy, which is central, because you have a massive tax cut, an historic increase in taxes next year. And what's happening is the longer we go without knowing whether it's one budget bill or perhaps two reconciliation bills, the more business uncertainty will persist and the weaker growth will be. So if a bill can be done shortly, that makes me very optimistic that growth will do quite well this year, and these rising recession odds are in fact grossly overstated.
Yeah, but Joe, how realistic is it really that we're going to get a bill in that timely fashion?
That's a good question. I don't know. I mean, this is going to be based on how the House is working with the Senate. The budget blueprint did pass a few weeks ago. That was sort of at least moved the ball further up the field. We'll see. Jason Smith, who scores the bill in the House, has said he can get something to the president's desk in short order because they were working on it during the campaign season. But we're going to see. And this is where politics sometimes can slow things down much faster than what markets want. But I expect there will be a bill, but I'd want one, somewhere closer to the first 100 days, not late in the year, which would be a risk for 2025 GDP.
We heard from the president yesterday saying that he is not watching the stock market, which is something that investors thought would potentially be a check on this administration's policies. Do you think that's accurate?
In the short term, yes. Look, the market had soared when President Trump was reelected. If the policies are implemented, it'll be very good for growth. I mean, my forecasts reflect that. So I think right now, you can't really worry about day-to-day volatility in the market. It's where's the economy 18 months from now? Where's the economy 36, 48 months from now? Like what does the forward look like? And as Secretary Besson has been commenting on, there might be some short-term pain. He actually said the economy needed a detox, and that's largely from unsustainable government spending, which has propped up the economy the last few years.
Joe, I'm curious to get your thoughts just on the idea of a Trump put and how closely he is watching the market, some of the selling action that we have seen. Of course, that has been dismissed from the president himself. But just given your experience and your sourcing and what you've been following, I guess, how big of a driver do you see that being for his policies?
Look, here's the thing. If the stock market goes down because it looks like there's two reconciliation bills and taxes aren't going to be done late in the year, that's a problem, and the president's going to be very worried about that. However, if he's able to implement the policies he's want with congressional action, then I think he'll be more than willing to look through any short-term distortions and be optimistic that the economy is on a much stronger glide path. So the equity market's important, but it depends how that market is declining. And right now we've seen some volatility, but again, you get corrections periodically through time. This is not unusual. So I think people are probably hyperventilating over market adjustments in a way that in the short term I think is overdone.
And we also heard Treasury Secretary Scott Bessent also talking again about his desire to have the 10-year low, to have yields low, to have energy prices low. How are you thinking about the impact that could have on our economic growth throughout the year?
Yes. So yes, energy is very central to the administration's program. If they can get energy costs down, then inflation is going to move lower. Oil moves literally 1-for-1 with the energy component within inflation. And I calculate we can lose easily at least half a point on the headline, and the indirect effects could be upwards of 0.75 of a point if energy can move down from where it was 80. It was actually $80 in January, $76 last year. Excuse me. If we can get it down to $58, which is where it was in the first 3 years of President Trump, the administration should be very successful in accomplishing much lower prices. And the fact that we've now hovering around 65, 66 a barrel is encouraging. So we do need lower energy costs without question.
Joe, always great to get your insight. Thanks so much for taking the time to join us.
My pleasure. Thanks for having me.
Talk to you soon. Well, stocks not too far from the flat line here this morning to close out what has been a very volatile week here for the markets. Much of that volatility fueled by whipsaw tariff policy and also the latest econ data. The VIX, it's a key measure of market fear that jumped to the highest level of the year as investors scrambled to navigate market volatility. Joining me now, I want to bring in David Booth. He's a co-founder and chairman of Dimensional Fund Advisors. His firm's strategy is rooted in academic, evidence-based investing rather than trying to time the market or pick individual names. Booth also helping to shape the landscape of institutional investing, a focus on quantitative investing and factor investing. David, it's great to have you here at Yahoo Finance. We also want to welcome in our executive editor, Brian Sazi, as well. David, there's so much to get into here with you. I'm curious just to get your sense of where we stand today. Following the sell-off that we have seen in the markets, obviously some of the jitters that are clearly very evident right now from investors, and then pairing that with some of these slowing econ data that we have been getting. How should we be thinking about where we stand?
Well, I think if you're talking about investing in stocks at all, you got to continue to focus on the long term. Trying to time short-term movements is pretty difficult. This week, the news that's out and the amount of adjustment all seems kind of sensible to me. I mean, unless you could forecast these events happening, it's hard to make money off of that. So we counsel our clients and our advisors to focus on the long haul, and educate people more and more about how markets work. The more people understand about how markets work, the less anxious they get in times like this, and the better able to stay for the long haul. And if you can stay for the long haul, you get that benefit of that magic of compounding. The way that Einstein talks about as being the eighth wonder of the world, So every time I've been in the business over 50 years, and if you look at the things that make me unhappy, it's every time the market drops a lot, a certain number of our clients panic and go, the sky is falling, I got to get out of here. And that makes me sad because it's very difficult to get back in once you make that decision. You get out and you go, then the market takes off and people go, well, the train's left the station, I can't get back in now. I thought it was overpriced before, and now it's even higher. So you just have to be very careful about all of that.
David, the headlines are coming in hot and heavy. Are your clients panicking right now?
No, we have, well, kind of the history of our business is we have new clients come in, probably like everybody else's new clients, and they're trying it out. And then you go through a couple of downturns and upturns. And over time, and we've been to the business 43 years now, what we have are clients that are really are long-term investors. And frequently when we call up and say, look, let's chat about it. You don't need to talk to me. I know what you're going to say. And, I'm in this for the long haul. Now, I do think there's the other side of the coin is, in setting investment policy, you try to set it for your particular situation, your conditions. Okay, so well, maybe the market, people focus on what's happening in the market. Maybe you should focus more on what's happening in your personal life. I mean, there may be more variability on what's happening in the personal life if you look at all the potential for a lot of layoffs and so forth. Maybe spend a little more time thinking about that. But in general, when you go home at night, instead of trying to time short-term moves, spend a little time with their kids and be a little bit more relaxed, I guess.
Are long-term investors becoming less optimistic on the long term because of the policies we're seeing from the administration?
One of the interesting things about studying the behavior of the stock market over long periods of time is you can't find much connection between which party's in power, which Congress is leading the way. Markets, it's always helpful to remind people how markets work. These are buyers and sellers coming together, and they don't trade unless each side thinks they got a good deal. Yeah. And that's what happens with that kind of environment is prices, the way I view it, is every day prices are getting set at levels that induce people to come in to invest. If prices were too high, they wouldn't invest. And that's kind of I think that's what comes out of the research into security prices.
And David, I know that in college, I believe you worked on a stock service that aimed at you trying to come up with ways to beat the market when you were in your early 20s, and I imagine that was very difficult. We have a lot of retail investors listening. Do you think it's possible for retail investors to beat the market, just given how much access to data, to information institutional investors have?
Well, it's possible. It's not likely, but it's possible. I think too many people feel like they are outsiders, and it's really just the insiders, these institutions, that are getting all the business. The good news about all the research is that's not true. If you look at, it's very difficult for individual investors to beat the market. It's very difficult for professional investors to beat the market.
Yeah.
And if you look at the likelihood of beating the market, it's about the same for each, which is very encouraging in the sense that it's the democratization of investing. Everybody has about an equal chance of picking a winner, I guess. And that's the way you would hope markets would work.
David, I guess your assessment of risk today versus what we saw 10 years ago, 20, 30, 40, 50 years ago, there's a lot of consistency there. I'm curious to get your perspective just how social media at all influenced some of the moves that we're seeing today, and I guess how that then affects maybe the calculus or psyche of so many investors today, when it didn't necessarily, obviously, before we had social media 20, 30 years ago.
That could be. I mean, there's definitely a lot more information.
Yeah.
Well, actually, there's a lot more data. I don't know how much information's out there. I mean, there's a lot more noise. I don't know if there's any more signals in that noise, but that's, you look at the VIX today, you were talking about that. It's shot up recently. As you look back on things, you look at the first Trump administration, one of the characteristics was extremely low volatility. And even a lot of that carried through with the Biden years as well. So over the last, say, couple of decades, we've really had historic low volatility. Now, will we go back to, don't know, but it's a worry when everything's so combative, and I think the amount of uncertainty probably is a little greater now. I mean, just read the newspaper. I'm not forecasting anything, but this, in some ways, it kind of reminds me of 2020, March of 2020. The market's down 20%. COVID has just really hit. People are going, God, what is this COVID all about? How can we look at all the uncertainty? And what we said back then, and I'll probably say now, basically every day, is, hey, look, people, when bad things happen to them, they just don't sit there and take it. They figure out what it takes to get it back on track. And same way with firms. And so with this COVID hit, firms are going to do what it takes to get back on track and use their ingenuity. And there'll be winners and losers along the way. And I don't know who the winners and losers will be. But what makes all of this go around, what makes this all work for all of us, is human ingenuity. People, I don't know, if bad things happen going forward, people will react to it. people sometimes say I'm an optimist. I'm a realist. That's human. That's the way humans work. We want to improve our lives, and I think that's the thing to keep in mind always.
So then I wonder how you're thinking about the tech trade. I know you don't believe in bubbles, but do you think that we are heading toward a tech, whatever word you would use for valuations?
I wouldn't. That's not my guess. My based on the study of the markets, I think maybe your best idea of what the expectation is basically about whatever the market does, maybe a little less, just because people view them as being lower risk now. And if you believe in risk and return related, if you think they are less risky now than the market, then you might expect a little lower return. It's a little simple, sounds simplistic, but look, let's call the Fab 7 or however many. I'm a basketball player, Fab 5. There's now let's say that's a third of the market. Well, think of that as being, starting with your portfolio, maybe that should be a third of your portfolio, and then argue you up and down from a third, not 0 or 100%. I think is a better way, and that'll keep you, out of kind of extreme outcomes, I think.
You're out with a new documentary. We've talked a lot here about noise impacting stock prices. I mean, your documentary is called "Tune Out the Noise." Have you really been able to do that over the decades of your career? Just isolate yourself and just almost like Warren Buffett, just invest for the long term and just focus on sales, margins, and cash flow, and kind of forget everything else that's happening around you?
Yeah, that's right. I mean, here again, going back to how markets work, I sit back and let everybody else do all the work, setting prices. And I figure however it comes out for the market, that's probably a better estimate of what prices should be than if I tried to figure them out. So I'd rather focus in on how my portfolio maps into my personal life. I'm getting closer to the retirement age. I keep telling myself that.
So you have a lot of dividend payers. Does that still hold true? Own dividend payers when you're nearing retirement? Is that like a good tip for those nearing?
Most people, it depends on your situation and what your objectives are. Most people, when they start planning for the end, frequently say, I'd like to leave some money for the kids and some money for some charity. And other than that, I want to spend all the rest. And so in that kind of environment, probably taking some risk off the table is a pretty good idea.
Well, David, sorry, go ahead.
No, in my case though, I look at it, some charity is the residual claimant on what I have. And so if I take the risk and that just means, and I lose, then the charity will end up with less money. At that point, I won't care.
Very valuable advice, David. It's great to have you here on set. Thanks so much for taking the time to join us.
Thanks for having me. I enjoyed it.
David's new documentary, Tune Out the Noise, explores how firms like Dimensional disrupted Wall Street's traditional model of investing. You can catch it now on YouTube. And of course, our big thanks to Brian Sazi as well. Coming up, a closer look at Wall Street's fear gauge with Stocks in Translation host Jared Blickery. That's coming up next.
Wall Street's measure of volatility has been steadily rising in the face of tariff uncertainty. So how do the VIX's recent moves stack up to history, and what does it tell us about the future of volatility? I'm Jared Blickery, host of Stocks in Translation, and I can hear Steve Sosnick's voice in my head. Don't call the VIX a fear gauge. Why not? And let's explore what the true definition is here. The SIBO Volatility Index uses options prices to estimate expected volatility in the S&P 500 over the next 30 days. So it's a measure of traders' expectations of volatility over the next month. And a lot of times when the VIX is going up, well, that's a sign of turbulence in the market, hence the fear gauge term. But the VIX can also rise when stocks are going up if they go up in a more volatile manner. That's exactly what the DAX is doing in Germany right right now. But I want to stick with the US, and let's go to a chart. This is a year-to-date of the VIX. I've got some candlesticks on here, and what you're going to notice is there's a nice block of days. There's about 11 days in here when it has been steadily rising day after day. Now, I want to contrast with another movement that we saw in December. We had a surprisingly hawkish Fed meeting, and this move in here, well, basically the entire distance was traversed from 15 to 25 plus in 2 days, and then we saw a quick fall down. Now, that critically is not happening right now. That entire move up and down was 11 days. We're still going up and holding here. So investors might say, is this the time to buy VIX for protection? And not to be glib here, the time to buy was when it's down here. You want to buy protection when you don't need it, not when you need it. And right now, investors are thinking they might need it. So to say, even if the VIX were to hover at these current levels, 25, doesn't mean that stocks can't go down more. They simply probably will not go down with the same momentum. All right, now I want to highlight another use of the VIX, and this is a seasonal map that we've cooked up here. And this is quite simple. You go back to 1990, that was the inception of VIX trading, or VIX calculations at least, and you take an average of every year. Since it's a mean reverting asset, it goes up and it goes down. You can just take those averages, and you come up with this map here. And right now we are in February, so I want to show you exactly how the year is traced out. You can kind of see that in green here. The bottom line is we have right on schedule in the month of February and leading up to it, we have spiked higher. And what you're going to notice is we're pretty close to a time when the VIX tends to turn down, and this is going into April. And guess what? April also coincides with stock seasonality, and that tends to be the month in which stocks lift off here. And I'll just close with that real quickly and show a stock seasonal map of the S&P 500 that we prepared and I went over the other week. We are right down here by the bottom. So we might have a little bit of a hiccup in March, but in April, it gets to be smooth sailing, and the VIX kind of confirms this. So tune into Stocks in Translation for more market decoding deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's take a look at Gap. Shares are surging after the retailer blew past analyst expectations for its fourth quarter, issuing an inline outlook. Gap noting that it will take a small hit to its margins this year because of tariffs. Our executive editor, Brian Sazi, had the chance to speak with Gap CEO Richard Dixon, asked him about the impact of tariffs, and here's what he had to say.
Our goal always is to minimize the impact to the consumer. We've got to work hard to do that with any cost inputs that happen. And whether it's the price of cotton or oil or tariffs, these are circumstances that any high performing company needs to deal with in their plans. So our ultimate goal as a consumer centric company is to minimize the impact on the consumer.
Obviously, tariff a huge concern here for Gap and other competitors out there trying to figure out and decipher and navigate what has been a very, very uncertain time for a number of business leaders and really across industries, obviously far-reaching the implications as of that. But Maddie, when you take a look at these numbers and some of the trends that were very clear within this report, there is a lot to like. There was especially their namesake brand Gap. That was something that was called out by Citi, the 7% jump in comp sales, exceeding expectations by a wide margin. They also had strong results in Old Navy and in Banana Republic. On the flip side, Athleta is struggling a little bit. I don't know how much to read into that, but I think the overall takeaway, and given just the magnitude of the gains that we're seeing here this morning, the street very encouraged by the turnaround playbook and what has been undertaken and done so far under its CEO, Richard Dixon, and what the quarters to come could potentially look like.
Yeah, and this is very anecdotal, but I feel like given the marketing and influencer marketing I've been seeing from Gap, I feel like they're potentially taking some market share from Abercrombie and Fitch, who we obviously saw struggling after their earnings print. And now I'm just constantly seeing influencers talking about Gap as the new kind of it girl brand in New York City. So we'll see if that continues to be the case on my TikTok For You page. But I noted to you, Sean, I think that decline in Athleta is really interesting. And if I would be curious to learn if that is about Gap specifically or if that's a decline in athleisure sales more broadly. Potentially we would get some clarity from the likes of Lululemon Airlines earnings on that. We spoke with On Holdings CEOs yesterday who are experiencing a lift in their athleisure apparel sales. So wonder if that is specific again to Athleta and some pressure that they're seeing in terms of consumer sales. And then, of course, I have to mention for our executive producer listening in, that Banana Republic has that new White Lotus line out today. So something to
looking
monitor.
that up. Yeah.
The success of that campaign.
Expensive,
We will continue
but
to
cute
cover.
clothes.
It is expensive, very vacation-friendly attire there. All right, well, next up, HPE falling on the heels of weaker than expected full-year profit outlook. They see adjusted earnings per share of $170 to $190, short of the $212 analysts expected. HPE saying its profits this year could be hurt both by tariffs and execution performance. The company also announcing it will eliminate 3,000 jobs. And I think it's really interesting to take a look at Hewlett-Packard Enterprise here. Those shares down 14% right now. They were down as much as 16% earlier in the trade. Analysts noting that those weak gross margins were adding to investor concerns. I wonder if we can pull up a longer dated stock chart here just to see the movement to the downside that we have been seeing over time here when it comes to HPE. You can see that drop over the course of the week. Of course, the biggest drop being today off the back of these results here. They talk about Morgan Stanley talking about inventory issues on AI being expected, but the pricing issues were an unexpected blip in the print.
Yeah, certainly we are seeing some pressure here on HPE's business. The CEO, Antonio Neri, saying that some of this just came down to execution performance and the lack thereof, that really weighing on the performance that we saw the most recent quarter. They talked about discounting during sales, higher than realized costs, a buildup of older generation semiconductors as some of the headwinds there that obviously have been weighing on their business, putting a bit of a dent in profit here for the quarters to come. I think as you look ahead, you try to figure out how HPE fits into the AI trade, how big of a player, how big of a winner. Maybe they will continue to, they could potentially be here over the next several quarters. I think some of that may be called into question just given the guidance, given the job cuts, given this strategic move that we have seen here from CEO Antonio Neri. So again, that drop of just about 15%. We could be looking at the largest intraday decline that we have seen since March of 2020. Finally, Nintendo under pressure amid tariff concerns for gaming consoles. Bloomberg analyst writing in a note that with tariffs on Chinese imports, game consoles like the Nintendo Switch 2 could see higher selling prices in the U.S., with most being either manufactured in China or at least relying on suppliers in the country for parts. That could significantly or be a significant headwind here for Nintendo, clearly reflected in the share price move to the downside here today, off just about 6.5%. And I think when you take a look at a storyline like this, the narrative here, of course, that begs the question, just the ability to pass along that higher cost to the consumer. And Maddie, you and I have been talking to so many economists, strategists, CEOs even over the last several weeks and several months asking about the consumer resilience story. And I think it's very clear that companies don't have as strong of pricing power as they clearly have here in the most recent years. And that really begs the question as to how much some of these businesses are going to have to stomach the higher costs and how big of a drag that's going to be to profits here in the quarters to come.
100%. I think what's interesting, and I did that story earlier this week about how tariffs impact prices for consumers, and we talked about how Nintendo was actually one of the products that could potentially get away with passing on the full cost to consumers because there's not really an off-brand console that you can get. If you want the Nintendo, you're going to get the Nintendo, right? But maybe there's a line where this is obviously a consumer want, not a consumer need. So perhaps the price increases that investors are anticipating are so high that they're thinking that consumers will just forego the product entirely, and that's of course, weighing on the share price today. Well, coming up, how AI is transforming the energy sector. We're taking a closer look at the future of the industry next, right here on Catalysts. Alibaba unveiling a new AI model that it claims could rival DeepSeek. This is just the latest development in the AI race as companies look to produce higher performance models and capitalize on growing demand. Now another race is on to power the AI revolution. Joining us now on this, Amir Orad, Kraken's CEO. And Kraken, as a reminder, provides AI-powered operating systems for energy utilities. Amir, it's great to have you on. Talk to me about Alibaba unveiling this rival to DeepSeek. How does this competition that's heating up among the AI players impact your business?
Yeah, we're seeing an arms race in the AI market, which may be actually good for consumers at the end because we get better and better technologies. When it comes to energy specifically, AI has two roles to play. Number one, it consumes a lot of energy, so we need more capacity in the networks. it can also be used to optimize the energy grid and actually make it easier for us as consumers.
I mean, just the ability to meet that demand. What does that look like?
It means we need, as a country, to have more energy. For the last 20 years, the US energy capacity was more or less flat. Now it's spiking up. AI, electrification, heating at homes, electric vehicles. We need way more energy than we ever did.
It's interesting in the context of just the popularity of AI. I think about the amount of energy it uses every time I ask ChatGPT one of my silly questions, and I start to wonder if it's really worth it for me to be using ChatGPT given where we're at with the climate right now. Is there a way to make AI clean energy friendly?
Yeah. First of all, AI is becoming more and more efficient all the time. Like most technologies, your phone, internet speed is becoming better and better. And clean energy is becoming cheaper and cheaper. Today's solar power is cheaper than any other alternative energy technology. So if you can use AI and have it use clean power, it's actually very cost effective and not polluting.
How receptive, just in terms of the capex that you're seeing from your clients, their willingness to spend right now, has that at all changed over the last several months, or what are some of the trends maybe that we could extrapolate from that, and then that tells us about future adoption?
Yeah. Even though the administration changed and a lot of the language used is different, both the previous administration and this one are talking about more energy consumption in the US. That's no different. The talk about climate change may be different, but red states and blue states are deploying solar panels every day because it's cheap and we like cheap power. So that is not changing. People are investing in grid technologies, investing in new generation, nuclear, gas, and clean energy.
And how are you thinking more broadly about the policies of this administration and how they could impact you? One thing that comes to mind is the focus of this administration on keeping energy costs low.
Yep.
Do you think that you could see more competition when it comes to people relying on old school energy models like gas, for example? Or are we past that?
The Economist had a big cover story that, again, solar is the cheapest, period, end of story. 10 years ago, we needed subsidies, we needed politics to help us. That's not the case anymore. So clean energy is cheap energy, and that's good for consumers, good for all of us, and AI can be used to optimize all of this energy production.
I'm curious just because you have such a global footprint.
Yeah.
The conversations here in the US compared to those that you're having with clients in other parts of the world, how does that compare?
You definitely see geopolitics come into play. People are looking for more energy independence and more local energy production. All markets are looking to modernize their energy systems. Our energy networks were invented before the iPhone, before the internet, before the electric vehicle. They have to be modernized, be it in Australia or in the UK or in the US. It's the exact same situation.
All right, well, Amir, we have to leave it there. Thank you so much for your time. Thanks for
Thank you.
taking time to join us here on set. You also want to be sure to tune into our special coverage of CERAWeek 2025 as industry leaders come together to talk about the future of energy. We will have interviews on Monday with Mike Summers. He's American Petroleum Institute's CEO. We have John Ketchum. He's NextEra's chairman and CEO. And Joseph Dominguez at Constellation Energy CEO. That's all coming out next week on Yahoo Finance.
Well, President Trump postponed tariffs on certain goods from Mexico and Canada for 1 month, after announcing the 25% levy just days before. Now, I'm going to talk about what companies are saying about the administration's ever-changing trade policy here. So several companies raised red flags just about how tariffs could hit margins, supply chains, and their consumers. Target warning earlier this week that it expects to see meaningful year-over-year profit pressure in its first quarter, partially due to that tariff uncertainty. Other big box retailers also anticipate an impact. Best Buy saying the vast majority of its products are subject in some form to tariffs. Macy's keeping an eye on the day-to-day changes, adding that it recognizes the potential inflationary pressure that these tariffs could pose. Meantime, Hasbro's CEO Chris Cox told Brian Sozzi on today's episode of Opening Bid that they're trying to offset the costs associated with China tariffs as best they can, but consumers may still end up paying more.
Maybe we can, trim off a couple things that the user won't notice and get the prices down. But at the end of the day, when you're talking about tariffs in the neighborhood of 20% plus, that's a cost that we can't fully accommodate.
And Boeing CEO Kelly Ortberg warning of rising costs due to the aviation manufacturer's fragile supply chain. In a speech to employees obtained by Bloomberg, Ortberg warned the tariffs were really expensive for the company. For companies with orders placed months in advance, their ability to offset tariffs is limited. Franco Salerno, co-owner of Dariana Bridal and Tuxedo, told the Chamber of Commerce he expects margins will take a hit as he can't charge brides for tariffs on already sold dresses. In some cases, boycotts have become more harmful than the tariffs themselves. Several Canadian provinces removing U.S.-made alcohol from shelves in retaliation for tariffs on Canadian goods. Jack Daniels owner Brown-Forman calling the move worse than a tariff.
All right, thanks there, Maddie. Let's take a look at the market here. Just about an hour and 10 minutes into the trading day, you're looking at losses across the board with the Dow, S&P, and NASDAQ now back in negative territory. You've got the NASDAQ now, the biggest decliner of the three, off just about 0.8%. NASDAQ 100 tumbling into correction. The tech sell-off really intensifying here, something we have been closely monitoring here on Yahoo Finance. Of course, questions just about surrounding the jobs print that we got out this morning, coming in slightly weaker than expected. Clearly not enough for the market to reverse any of its earlier losses this week in a more sustainable fashion as of late. But again, all three of the major averages moving to the downside here. We now have the NASDAQ off nearly 1%. We'll be right back. Tech leaders are heading to the White House. President Trump reportedly planning to meet with the CEOs of HP, Intel, IBM, and Qualcomm, according to a report from Bloomberg. HP confirming in a statement that the company is set to attend a White House meeting, saying, quote, some of the topics top of mind for our leadership team are trade policy and U.S. manufacturing. This comes after President Trump called for the elimination of the CHIPS Act.
The Act is a horrible thing. We give hundreds of billions of dollars, and it doesn't mean a thing. They take our money and they don't spend it. You should get rid of the CHIP Act, and whatever's left over, Mr. Speaker, you should use it to reduce debt.
The Trump administration is still legally bound to distribute over $30 billion in CHIPS Act funding through fiscal year 2026. Some of the largest beneficiaries of the CHIPS Act funding include Intel, Samsung, and TSMC. President Trump announcing a separate deal with TSMC worth $100 billion. That came earlier this week. Now, since the CHIPS Act's passage in 2022, domestic chip spending has risen by over $100 billion. President Trump has said that he shares the goal of the CHIPS Act to see as many as 40% of AI chips made here in the U.S. The Justice Department and Google are scheduled to submit final proposals today for restoring competition to online search market. The proposals are the next step after a judge ruled last year that Google illegally monopolized the online search market. Yahoo Finance's Alexis Keenan is here now with a closer look. Alexis.
Hi, Seana. Yeah, so today is the day when the Justice Department, in their big antitrust case against Google search, the market for search, they have to put in their final proposals, that Google does and the DOJ does, to say this is how we want the remedies to look. How do we fix the problems in the search market? The judge in the district court in the District of Columbia finding last year that Google held an illegal monopoly in the market for online search. Now, why these filings could be really revealing is because this case has gone through now 3 administrations. You had the Trump administration filing the case and doing the investigation. You had the Biden administration prosecuting it and filing what is a preliminary idea of how these remedies should look, what should happen. Well, according to the Biden administration, they wanted to do things like end the contracts that make Google a default on devices, particularly Apple, but across different mobile devices. Also, things like limit Google from investing in AI, and a big one, maybe even break up Alphabet and require that it let go of its Chrome browser. So last week, Google reportedly had gone in to talk with the new Justice Department officials to say, let's not go ahead with this breakup scenario. Let's find another solution. So negotiations probably still underway here. But the case now bounces back to the Trump administration. So these documents that are filed today, they should be really revealing about a big question in the antitrust world, which is, how is this Justice Department now going to handle antitrust? Is it going to be more aggressive than Biden, less aggressive? Is it going to look the same? And on top of that, you have another wild card, which is the fact that Gail Slater, who's Trump's pick to lead the antitrust division, she still has not been confirmed. So she maybe not be as much in the mix as she will be. So much to come. A lot could change in this case just today.
And that's a great rundown of what's happening over at Alphabet with Google. But what do we know about some of the other pending cases and just some of the questions that remain for those as well?
Yeah, so this might be, right, a preview of what's going to happen in these other cases to some extent. You have the Justice Department and the FTC, which share jurisdiction for enforcing the federal antitrust laws. You have cases against Apple, Amazon, Meta. You have a case with the FTC going against Meta that will go to trial in April on the 14th. You also have Amazon facing a couple of cases. Apple, their case was brought by the DOJ. The DOJ saying that the company has illegally monopolized the smartphone market. That one hasn't been set for trial yet, but certainly a ton on the plate. And we would expect that a case like Apple's, for example, would go all the way into the next administration as well.
All right, Alexis, great breakdown as always. Thank you so much for joining us. Well, Elon Musk's SpaceX experiences its second setback in a row, the company losing connection with its Starship rocket shortly after it launched out of Brownsville, Texas last night. SpaceX later saying on X that the spacecraft exploded while ascending, and the company is working with safety officials to collect debris. The FAA saying it will require SpaceX to investigate the cause of this explosion. Now, a similar incident happened in January when SpaceX's Starship rocket blew up shortly after launch, causing the FAA to impose flight restrictions in the surrounding areas to protect other planes from being hit by debris. Last night's explosion also disrupting commercial flights, with planes in parts of the Caribbean being diverted, according to the aviation tracker Flight Radar 24, and the FAA delaying departures from Fort Lauderdale and Miami airports. SpaceX was successful in guiding the rocket's booster back down to the launch pad. That is the third time the company has been able to do so. And that is a critical part of SpaceX's long-term goal to regularly launch rockets into space. We're going to have all of your markets action ahead here on Yahoo Finance. You're still looking at losses across the board. Your S&P off about 0.6, your NASDAQ down about 0.7%. We'll be right back. 90 minutes into the trading day, and the major averages are all moving lower. This comes after a week of major volatility from tariff policy and that slightly lower than expected jobs print. We also had weakness for tech stocks this week as well. So how should investors be approaching all of that uncertainty? Well, it's time now for our weekly FA Corner, brought to you by Capital Group. And joining us for our first rendition, we've got Catherine George, Wealthstream Advisors financial advisor. Catherine, great to speak with you here. Just want to get a sense of what you're hearing from clients about how they're digesting the volatility right now and what they're most concerned about.
Yeah, I mean, I think a lot of times we have to separate what's going on in the world and our financial situation and markets. Markets don't always act rationally, so it can be tough for people to take what's going on in the world and really apply it to their long-term plan. But really, I think the most important thing to make sure our clients feel comfortable is making sure they have enough cash on hand. Making sure you can weather any upcoming storm and that you don't have to, sell stocks at the worst possible time. Cash is really king, especially when you have clients that are nervous.
Are you seeing some opportunity, Catherine, to put some of that money to work? I know it's important, obviously, to remain some sort of your positioning within cash, but to the degree of the sell-off that we have seen, is that a bit of a buying opportunity?
I think it really depends on which market you're looking at. When we look at the companies that everyone is talking about in the news, and that's mostly tech companies, but really companies within the S&P 500, they have really outperformed their long-term averages in recent times. So even with this recent sell-off, when you look at the price you're paying for the profits and the money that's coming in, is it on sale? I don't know. But when we look at other places of the market, whether that's value companies or smaller companies in the U.S., but even internationally, there are opportunities there. And that's really just because these larger U.S. companies have had such outsized returns, and really over the last 10 years. And at some point that has to revert back to the mean. So when that will happen, of course, nobody knows. But I do think there are other places of the market that haven't had those outsized returns, and that's a longer term trend that you could really make sure you're diversified and you're thinking about all places in the market.
Well, Catherine, earlier we spoke with David Booth, Dimensional Fund Advisors founder, and he was warning about the risks of pulling money out from the market. Let's take a listen.
Every time the market drops a lot, a certain number of our clients panic and go, the sky is falling. I got to get out of here. And that makes me sad because it's very difficult to get back in once you make that decision. You get out and you go, then the market takes off and people go, well, the train's left the station. I can't get back in now. I thought it was overpriced before, and now it's even higher.
So in our final minute here, Catherine, you had mentioned this. Where are the corners of the market where you think investors can find some of that safety without selling and risking losing out on all that compound interest?
Well, I think even if you're going to need the cash within the next 2 years, and for really nervous investors, maybe even 2 years, you need that cash no matter what. So regardless of what's happening in the market, I would take that cash out now and make sure that you can let the market do what it's going to do without your fears and concerns. With that being said, stocks have still had, a decent run over the past couple of years. So it's not like we are, taking at such a big hit and such a big loss. That being said, if the market continues to go down, there are still things investors can do, whether that's rebalancing. So making sure you have an asset mix, a plan in place. And if your stocks fall, there might be an opportunity to take some of your bonds and buy stocks at this low opportunity, and making sure that long-term plan is in place. Another piece is tax loss harvesting. If you're in a high tax bracket or in a city with high taxes, could be a good opportunity to do some tax loss harvesting and planning and save some money on taxes. So there are things that you can do. But I would say prepping in advance and making sure you have the cash, you have a plan in place before, continued potential market downturns is really important.
All right, Catherine, we got to leave it there. Thank you so much for joining us. We appreciate it.
Thank you.
And before we close the show, I want to take a moment to wish the best to my co-host, Seana Smith. All of the best to her. She prepares to welcome a new member to her family. Seana, we're going to miss you so much. I hope that I get pictures as soon as you are physically comfortable. And obviously, you have to deal with creating and birthing a human first. But obviously, love doing this with you every day. And we'll miss you so much and wishing you all the best.
Thank you. We're very, very excited. This will be our third boy. Right. So if anyone out there has any tips on how to navigate that, especially having 3 boys, I'm always welcome for any sort of insight there. But I very much am going to miss you guys. I think it's safe to say my hands are going to be quite full, at least for the next several months as we try to figure out life with 3. But we are very, very excited, and I'm going to miss you guys. But I'll be back before you know it.
Of course. No, we will miss you so much. It's crazy. We've been doing Catalyst together for about a year. So
I know.
Can't wait to get back
Almost
to it
day,
with you.
actually.
Almost to the day. Can't wait to have you back, Seana. Thank you so much for everything. We always appreciate you. Stick with us. We're going to have more ahead for you on Wealth.